Okay, so now from just the previous video, video 1, you know more about the inner workings of all financial markets than 95% of traders. But that does not show you how to extract money for yourself, which is what you will learn about coming up in the next video. And don't forget, there is a downloadable guide to all the videos in this trader training in the description below, and a couple other links that you might find important. Okay, so the importance of the cash market. Well, 1, the cash market exists as a physical reality. 2, the cash market can quickly define what and how much is owned by whom. The cash market provides institutions a convenient location to place the endless streams of money that arrive into their bank accounts each and every day. These 3 components can be likened to an engine that is consuming a huge amount of fuel, money, without actually going anywhere or doing anything. It's just churning over and over in an endless cycle of consumption. Worse still is that the market makers have a large siphon tube leading right into the fuel tank that is blatantly siphoning off an endless stream of profits for themselves. All this is done hidden behind a facade that is so thin that it would be laughable if there was not so much at stake here. So institutions, walk into any business district in any city in the world and look up, and you'll see a lot of very tall tower blocks. If you have 5 minutes to stop and look at the names and roles of these buildings, you'll soon realise that banks and insurance companies dominate the skyline. Imagine the cost of running just one of these single buildings, then add in the salaries of everyone contained in the building, then look down and see if you can see the production line with goods of value being produced streaming out of them. Of course, you'll not find any goods streaming out because these buildings make their profits by other means. Banks make money by moving money. They do not directly produce anything of life-enhancing value. They can take in $1 over the counter and loan 3 out in interest by moving digits on a computer screen. Debt is a bank's biggest asset. Insurance companies take our money, push it back to the banks and so-called investments. Our pensions are absorbed under the guise of producing wealth for us in later life. Few will bother to do the math or even contemplate that huge sums are being siphoned off for salaries and running these skyscrapers. Integrated with the banks and above the banks, we have the market makers, like hidden unseen forces that move billions of dollars around the world in strategic movements that can bring whole countries and economies to submissive states without the hint of open aggression. Now, I could go on and on about this, but this is not the purpose of this course. However, it's vital to understand, let us say, that the financial markets are a business. The market makers are in the business of producing profits on a vast scale. We're now going to move on to those terms that I introduced earlier. Active and inactive investors. When we looked at who exists in the cash market, we had 3 groups: institutions, private investors, active and inactive holders of stock. The second of our 3 was shown as private investors, but here we seem to have skipped over them and arrived at the active and inactive investors. The reason for this is because the private investors can also be active and inactive, so for ease of explanation it makes sense to just look at what these 2 groups get up to in terms of trading activity rather than getting bogged down in details such as names. So active and inactive. The names tell us exactly what they are. Active investors, traders, will be actively involved in trading on a daily basis. Inactive investors will be inactive and thus not trading very much at all. This seems like a trivial and obvious point to cover, but like I explained earlier, we need to look under the surface of everything that is presented to us, so we're not so much interested in the names given to anyone or anything, rather we need to know how these groups interact with the market, the effect they have, and how the market makers use these groups for their own direct benefit. Now let's break it down further to find out how these groups actually function. So active holders. Well, active holders of stock will be buying and selling stocks on a daily, weekly, monthly basis. These types of traders will be opening and closing trading positions, thus buying and selling as part of their investment or income producing goal. They'll have trading goals that are centered around making money now and are thus active in trying to achieve that. Now these types of traders will have varying degrees of market knowledge, but will be relying to a greater degree on market influences for their trading decisions. So what are market influences? Well, these will be things like trading tipsters, broker recommendations, newsletters, newspaper reports and technical analysis chart patterns. They'll be generally drawing from any sources that can basically try and gain an edge on their trading so as to produce profit. Now, given the way in which these traders trade, you can maybe see how they would be open to outside forces, outside forces in this case being any information they're actually absorbing. Now, as this information is being absorbed by these traders, so they're making commitments to either buy or sell individual stocks, etc. Their trading actions are adding to the liquidity or the volume of traded business. They are very much part of the market on a day-to-day basis, and as such, they are an active component in the overall market maker's business model. Let's now see how this group compares to the inactive. So inactive holders. Now inactive holders of stock are defined as individuals who own a stock in a particular company but are not actively trading that stock. Now these inactive holders may have little or basically no market knowledge. They may even hold stock that has been given to them or say left them in a will or something. They may be the type of person who has no interest in the markets and would not even have ever considered trading, but somehow they ended up owning some stock basically. Now there are actually more of these stockholders than you might imagine. Now these inactive holders, many, like I say, not even know how to buy and sell stock, especially if they left it in a will. They're not likely to be involved in the watching of stock prices and or listening to news that is stock market related. In short, they have little interest in basically what they hold. Now these inactive holders are highly unlikely to be influenced by market action. Now you might think from this description that they have little interest to the market makers and have no market impact. However, they play a role because they have stock that cannot easily be obtained for trading. They also offer a level of stability for a stock. For example, say in the case of someone holding shares in a utility company that has no intention of trading them, they literally lock up that stock, which may cause a shortage for demand and thus cause a rise in value. This rise may have nothing to do with the true value of the stock. Let's now have a look at two more groups that will have an effect on how stock changes hands, and of course when those exchanges take place as well. Weak or strong holders. These are two distinct groups of traders that influence how and when stock changes hand. Now, a weak holder is defined as someone who is easily persuaded to buy or sell and may have urgent needs to buy or sell due to financial pressure. A strong holder, on the other hand, is defined as someone who is not easily persuaded to buy or sell and has no financial pressure to do so. Now, imagine that both of these stockholders are holding the exact same stock. Further imagine that both of these stockholders have just heard a news story that seems to negatively impact the value of their stock. Who is likely to be persuaded to sell that stock now? Likely, you're thinking quite correctly, the weak holder. Now, the most important thing that you must take on board from this is that the actual stock of a company will have a stated value according to the quoted prices for that stock. However, the value of that stock will be influenced and reflected depending upon who holds that stock. A weak holder who holds a large block of stock or shares could easily be persuaded to sell that stock and thus drive the overall price of the stock down to lower than its real value. A strong holder without any financial pressure may now see this as a great opportunity to add this stock to their stock in the anticipation of later higher prices. Strong and weak holders affect the market in different ways. Let's have a look at this now in a graphic format. Here we have a weightlifter holding a vertical bar on the point of balance. At the centre point of the bar is the current price of our imaginary stock. Let us assume that there is some negative news about our imaginary stock and the weak holders at B start to sell, which has the effect of slipping the weight towards the centre line of the bar. Clearly this would cause an imbalance in the bar and it would start to tilt to one side. Now this slide is not to show falling and rising prices, it's just to show how imbalance can occur, not by the actual true value of a stock, but something as simple as how easily someone can be influenced to buy or sell. Imagine how quickly and severely the bar would tilt one way or the other if the strong holder on the outside of the bar, where it's more stable, was suddenly persuaded to move their stock. From this we can say that weak holders are defined as holders that are easily persuaded to buy or sell any given stock, and strong holders are defined as holders who are under no pressure to buy or sell. Certainly these weak and strong holders have characters, and it is said if you understand someone's character, you're able to better understand them. So let's have a look if we can understand them a little more. Characters of the weak holders. The weak holders are highly susceptible to manipulation. This can be via news, rumours, or just because Joe next door says so. They are easily persuaded to either buy or sell stock. They will generally be ruled by emotions that cycle around fear and loss. They can be easily persuaded to buy and sell at poor prices and under volatile market conditions. The characteristics of the strongholders. Now, strongholders are not easily manipulated. They will have their own opinions and make their own trading decisions. They may hold stock for the long haul. Now, institutions are often for the long haul and make up the greater part of the strongholders. Let's now have a look in more depth now, say, at the strong and weak holders and how their characters translate into the availability of stock. Strong and weak are same stock but different. Now that's a bit of a contradiction, right? How can the same stock be different stock? Well, it has to do with who is holding it and how that will affect the trading of it. Now let's now examine the concept of fixed and floating stock, because depending upon whether stock is fixed or floating will have a direct impact on how and when that stock becomes available for trading. Now just a side note here, it may seem like I'm totally ignoring other markets such as options, commodities and currencies, etc. But do bear with me, because pretty soon you'll discover how all this fits together into one simple yet devastatingly effective trading method, regardless of what market you want to trade. Let's now have a look at the characteristics of floating stock. Floating stock is the name given to stock that is readily available for trading. That is any stock that can easily be obtained for buying or selling. Now think back to strong and weak holders to get a handle on why this type of stock might be so readily available. Now remember, depending on who holds a stock will dictate its tradability. Let's now have a look at the nature of this floating stock. Now the nature of floating stock is often high liquidity stock. High liquidity means it is very easy to buy and sell. There may be lots of activity buying and selling it. There will be neither strong or weak buying or selling pressure in any one direction. It literally floats around changing ownership. We can say to a degree that the beliefs about the value of this stock is fairly evenly spread and non-committal about future value up or down. Let's move on to fixed stock. Now fixed stock is stock that is not readily available for trading and cannot easily be obtained. Now think back to who might be holding this stock. Is it the strong holders or the weak holders? Now you've probably got that right, it is indeed the strong holders. Let's now have a look at the nature of this stock. Now the nature of fixed stock is stock that is not readily available for trading. The reason for this is because it might just be held by non-traders. Remember, Granny leaves you 1,000 shares in XYZ company and you don't know what to do with them, and really you don't care. Your 1,000 shares can be truly defined as fixed stock because of those very reasons. Now the same stock could also, for example, be held by institutions in what they call their long-term portfolio. Again, same stock, same fixed nature, but the reasons for holding that stock are vastly different. Well, we've now about wrapped up this section. Let's have a look at what we've covered so far. In this section, we looked at the purpose of the markets, why they're there. We covered the cash market by defining what it is and just how important and who exists in that market. We got to the heart of what makes the cash market so important. And we also examined the types of traders and the effects of those traders in terms of active and inactive holders, and also how this related to either strong or weak holders. And finally in this section, we looked at fixed and floating stock and how this reflects on who holds that stock. Now this section is probably the hardest to work through, but without a solid understanding of how stock actually changes hands and under what conditions, what follows would not be easy to grasp. Now, so what we've done here really is lay down a foundation upon which everything else is based. Now in the next section we're going to put this all together in such a way that you can see how the market makers operate their business. You're going to learn the exact process that they run through every day in every single market. If you're not very excited about what is coming next, you should be, because what follows has the potential to make everything you ever wanted from your trading become a solid reality. Let's get to it. The market stall. The business of the market makers is like a market stall, and just like a market stall, in order to make money, several things will need to take place. Stock, for example, will have to be accumulated, prices will have to be manipulated to make the offerings attractive, and customers will need to be persuaded to part with their money, which is a profit released for the stall holder. We can think of this like a sequence of events that must be cycled through every day in order for the business to be kept running. The market maker's role. Before we can understand accumulation, we need to better understand the market makers in terms of what their role is and what they can do. Their very public face is clear cut and simple. The market makers maintain a bid and ask for any particular stock or security. In this respect, they are literally making a market and profit from the difference between what they offer to buy from you at, known as the bid, and what they offer to sell to you as, known as the ask. This is the bid and the ask. The difference between these two prices is known as the spread. It is this bit in the middle that is the market maker's legitimate profit. This will be the process of, the process of competition will keep this small, normally about 1 or 2 pips. Whether you win or lose, the market makers always makes money, which is fair given that they are in fact making the market and thereby facilitating trading. However, there are a few not quite so visible perks. Now, market makers' perks, they have direct knowledge about fixed and floating stock. They know at all times whether there is supply or demand. They can actually create supply and demand. Some additional perks. Now, it would make sense and be of interest to market makers to share information with each other. Market makers are legally allowed to withhold information for a period of time. Market makers can and do trade their own accounts. Now, if this sounds a little bit like hands in a cookie jar, then you're probably thinking along the right track. Let's now get back to our sequence of events and look more closely at accumulation. Accumulation. Now, accumulation is the process of accumulating either buy or sell orders that will later be released for profit. Accumulating buy orders will later be sold into a rising market, and accumulating sell orders will later be sold into a falling market. Now, creating supply to accumulate. The process of accumulation cannot just start at a random point in time. There must be some preparation. Now, the preparation will involve creating supply, as once there is supply in the marketplace, the market makers can start accumulating without putting the price up. Imagine what would happen if there was no readily available supply and the buying started. Immediately this would be spotted and the prices would start to rise. The cat would be literally out of the bag, so to speak. The best method is to first create supply, and to do this the market makers can supply press releases, companies in question are given airtime, stories about how one company is going to affect another. In some cases statements were made about how one complete market sector is going to affect something. Basically, any tactic that will place ideas about the future direction either up or down in the minds of traders. So who is doing this accumulation? Market makers' sales teams. Sales teams are on huge scales with entire floors in these tower blocks being occupied. Make no mistake, there's nothing random about what these sales teams get up to. If you've ever had a call from a broker suggesting a particular stock might be a good buy or sell, now is the time to buy or sell, he or she is just doing the bidding of the masters cracking the whip. Now, these sales teams can be turned onto any stock or market to start working that stock or market to either accumulate or distribute. As a simple example, salesman A is instructed to buy XYZ stock, salesman B is instructed to create demand for XYZ stock. Calls are made to holders of stock suggesting that a new stock they might like to take a look at. Whilst on the phone, simple statements like, by the way, this stock may be good or this stock may be bad. The process has started, and this repeated hundreds of times in a day will create supply that the market makers can start to accumulate. Complete game plans are often set up to target large areas of the market. And just before we leave this topic, have a think about the XYZ stock that is now being promoted. And if you expand your thinking outwards to a full circle, you'll see how that stock is now being promoted because last month that was the stock that was being accumulated. Accumulation by sales teams. Now, each time calls are made that result in holders of the stock selling, the price will show movement. This will allow the price to start as a trend, maybe downwards. This now has a big impact on the market, as now the price of this stock can be seen to be falling and flashing red on screens. The holders of this stock see this and think, the brokers were right, this is going down, I'll sell this now and maybe take some profits and avoid any losses. They call the broker back and he buys the stock. He has accumulated stock without putting the price up. Now expand the brokers to maybe 100 brokers all doing the same thing, and you can start to realise the scale of operation and just how much can be accumulated and then remarketing in this way. And by the way, as a side note here, do not be thinking I'm portraying the brokers as the ultimate market makers. It's the market makers at the highest levels that have the brokers do their bidding. The broker does not come into office on Monday morning and suddenly decide he's going to start targeting a particular stock. Critical accumulation factors. In order to do this, supply must be created. Remember back to the floating stock, this must all be accumulated and thus turned temporarily into fixed stock. And during this time, there must be a steady price with low trading volume so as to not bring this to anyone's attention. Now, once all the accumulation has been achieved, floating stock has been removed and nobody else is selling into the market makers, the stage is now set for the next step in the process. This next step will likely start in a few days or maybe even weeks, depending on what type of activity is going to happen. Now let's now have a look at this demand and where it comes from. Creating demand. Now I just listed a few examples here. The brokers get back on the phones to other potential buyers, start to circulate rumours, maybe some press releases hinting that things might be good on this stock. The respective company maybe is contacted for a bit of airtime to say how good things are looking for the future. Distribution, profit release. Now what happens here? Well, pretty simple. A few buyers on the advice of brokers will buy and thus transactions take place and the volume of traded business increases. This will show up visibly on traders' screens and charts. Prices will start to flash blue. The brokers now call back the potential buyers they called earlier to see if I told you this would move, maybe you want to get in on the action. Now, as a result of this process, the prices start to rise further and now demand expands rapidly. The brokers are now selling into this rise all the stock they'd earlier accumulated at lower prices, thus making huge profits for the market makers and creating large bonuses for the brokers. Never lose sight of the fact that this is a very simple business operation. Contrary to popular and perpetuated myth, there's nothing complex going on here. It is just given an air of respectability. Market makers making money. It's really very straightforward. Market makers are making money from transactions they carry out as a service to the investors. They get to charge commissions on each and every transaction. The more transactions they make, the more money they make, and the larger bonuses they pay to the brokers. They are in effect controlling supply and demand. Overall then, we can say that the market maker's business consists of accumulation and distribution. It's a bit like a warehouse pushing accumulated stock out to brokers, wholesalers, who in turn push it out to the investor. This complete process is a profit release exercise for the market makers, and it's repeated over and over again. Let's now have a look at that supply and demand. Okay, so I know that was a big session to work through. However, it has laid a foundation from which your trading success is going to take off from. From here on in, things are going to heat up and get exciting. Now in the next video, video 3, you will learn all about Trader's Prism. You'll find out if you're already in it and other key factors that will greatly influence your trading success. This could well be a watershed moment for you as your trading turns a corner. I'll see you over there.